Hello, International Finance students. This week, we will be looking at international capital budgeting. So we'll talk a little bit about domestic capital budgeting and then show how it's different when you think internationally. So capital budgeting is the process whereby an organization might think about utilizing most efficiently its capital. So in particular, monetary capital. So you can imagine I've got a company, and I have some money that that maybe we had some profit this year, so there's some cash available, and then also we have some borrowing capacity. So our corporation could still borrow, maybe a few $1,000,000 and retain a AA credit rating, which is our goal. And so we say, okay, we can borrow some funds in the bond market. We can use some internal cash. So we've got some money available that we could spend on a project, and maybe that project and maybe some of those projects are domestic and some of those projects are international. And there's lots of different options, and we're trying to decide, okay, which of all the things should we do? So the way that academics assume that businesses should think about this kind of question, and we know from survey results that actually corporate, chief executive officers almost always do think about this question in this way, is to say, okay, let's look at all of the cash we put into this project and look at all of the cash that the project would generate over its lifetime. And because money shows up at different times, we're going to have to adjust those cash flows based on their risk, right? The riskier the cash flow, the higher discount will apply to those cash flows. And by discount in this case, we really mean, it's like an interest rate. It's like interest rate math, but it's a discount rate because we're reducing the value of those future cash flows by a risk appropriate adjustment factor. But that adjustment factor gets applied like an interest rate would get applied, is just maybe higher than the market rate of interest for a risk-free loan, right? So if the federal government can borrow for 10 years at 4%, the project can borrow for 10 years at 7%. And so that 3% represents a risk premium for borrowing. And this happens in the bond markets as well, right? The higher risk bonds have higher interest rates to compensate for putting up with risk. Anyway, so the companies are in a position to say, okay, we've got, we'll get some money, and we'll get some one year and some another year, and we want to interest rate just that back and find the total value. So I just want to, demonstrate how that works in a really simple example. So let's just take a really simple 3-year project, and here, let me make these. Make these a little wider. Okay. So we're going to say, all right, we've got year 0. Turn numlock on year 0, year 1, year 2, year 3. You can even center those. This will be fun. Boop. All right. Oh, yeah. Oops. Just center. Not working center. All right. So I've got year 0, year 1, year 2, year 3. Oh, and let's get a column in there. So we've got cash flow. Yeah, maybe I overdid it. It was a little wide. Okay. Look at cash flow. So we'll say, okay, what if we put in $10 million? You put in $10 million, and then we earn 3, and then 6, and then 2, and then the project is done. Right, so it kind of, has a ramp-up phase, and then a productivity phase, and then it goes in decline, and we shut it down. And you can imagine this is, what if this is like, something like a line of, maybe like a particular clothing line or something, right? Where, trends sort of drift, but you have something that, our best guesstimate is that it is of interest to consumers for about 2.5 years. And there's kind of a peter out phase while inventories get cleared. And then we have to, reinvent, do a different design, come up with something that is, more fashionable. So we've got these cash flows, right? So if we go back to the, let's look at this formula. So if you're not familiar with this notation, right, this is the Greek letter. It's capital sigma, right, uppercase S. It just means sum, right? So we're saying, okay, we're adding up, right? So we've got it's really a shorthand way of writing a bunch of stuff, right? So we have T is 1. So the cash flow the first time, right? And then the cash flow the second time, and the cash flow the third time. This should actually be a 0. But we're saying, okay, we want to take these cash flows, and we're going to add them. And notice, right, we can't just add the right now cash plus the 1 year from now cash plus the 2 years from now cash. You can't just add those up because they arrive at different times. It's really like apples and oranges. So to fix it, we're taking this money and we're dividing by 1 plus K. K is a cost of capital. It's the interest rate adjustment factor. You can think of it this way, right? Let's imagine that I had $100 and I put it in the bank right now. Well, in a year, I could have 105 pretty easily, right? So if someone came up to me and said, hey, do you want $100 now or do you want $105 next year? I can pretty safely say, I kind of don't care about that. So, I'll take the 100 just because why? It's less annoying. But right, if it was 100 now or 106 later, I might say, oh yeah, wow, 106, that's really good. If I took the 100 and invested it, I'd only get 105. So it's kind of like I get a free buck by being patient. So I'll take the 106, right? So and whereas 104 would definitely be no. It's like, no, definitely not. I'm just going to take the 100. I can get 105 on my own. So on some level, on an interest adjusted basis, 105 in a year is equivalent to 100 now, and 110 and some change is equivalent to 100 now. So money, because interest compounds, right? Because you have interest on interest on interest, and that money grows exponentially. That means money in the future is actually exponentially less valuable, right? Like if I told you that, I could literally promise everybody that I encounter every day in my life $1 billion 1,000 years in the future, and it wouldn't even, it wouldn't add up to a penny because it's because of that exponential. So money in the future isn't worth as much. So that's what we want to factor in. So we have these cash flows that naturally occur from operating the business, and then you have this TV that's terminal value, that's some kind of terminal payment, and then we subtract off that initial cost. Oh, I see. That's why T isn't 0. They have this set aside on its own specifically as the initial costs. So let's think about this project that we're doing, this example. So we're going to kick in 10 million, and then we have 3 and 6 and 2. So now we need an interest rate. So we're going to say that, let's add some, so we need an interest rate and we need some terminal value. So we'll say interest rate is 8%, and we've got a terminal value. So this is when we shut things down. You'll see a terminal value of 2 million. And now we're ready to think about this. So So I'm going to do, so we want to interest adjust this. So this one's fine. This is just 10 million, right? We just pay 10 million. So this first one we get 3, but it's not just 3. It's 3, if we look at our problem, right? It's 3 divided by 1 plus the interest rate. So if I go back to here, I have this 3 divided by 1 plus the interest rate. Now, this is Excel, so I'm going to, I pushed F4 on my keyboard to turn that into an absolute cell reference. I mean, we can also just rename this to be, right, if I click on, well, anyway, let me do that in a second. And this, right, is an exponent there in the formula, right, to the power of the time period, right, to the power of 1. So really what this looks like right now, right, if we unwrap all of this Excel, it's 3 divided by 1.08, right? 1 plus 8%, 1.08, which is going to be slightly less than 3. And I can actually, hold on. So a fun thing you can do, right, let's change this G2 to be R. And then, R, enter. And then I should be able to, maybe it doesn't like one letter names. Return, there we go. So now if I go here, I can reference this as RET, and it will stay put. So we've got cash flow divided by the required return to the power of the years, right? And so now this one, right, is going to be 6 divided by 1 plus r to the second power. Right, because we have to pay interest on the first year and interest on the second year. And so these cash flows are declining in value here, right, as time passes. So this too, right, in percentage terms, this discount is getting bigger. And now for this terminal value, we need to do some adjustment, right? So this should be pointing at this terminal value cell, and this should be, it's also 3, right? It happens also on that last year. All right, so we get 2 million, and that makes sense. These are the same number, right? Because we get 2 million cash from running the business and 2 million from shutting it down, selling the operations and stuff. And so if we follow that formula, right, we add up all of these cash flows, right, the operating cash, the terminal cash, and add the negative initial costs, and we get a present value opposite. Now, notice we're pretty ahead on money, right? This is, if you look at the total, this is 9, 11, 13. So we put in 10 million and we get out 13. Right? So what does that look like if I do my final NPV? So my NPV, right? NPV, net present value, that's the present value of all the cash flows, net of the initial costs, right? So here's all the cash flows that we get, right? Add up all those cash flows, and then take off those initial costs. I'm doing plus because I have this in as a negative. All right, I could have done minus 10 if it was positive 10. And what do we get? 1. Okay, so Y, right, pretty simple, was $13 million, but it came in the future. So it's worth less, and in fact, it's worth enough less that this is, only positive, for about $1 million. So what that mean? That means if the company were to invest $10 million in this project and get it up and running, and then they found a buyer for the division or a buyer for the project that agreed with them on the forecasting assumptions, then they would pay something like $11 million would be a fair price for this thing. So basically coming up with the idea itself is worth $1 million because it's sort of like Midas, right? You're sort of spinning straw into gold, right? You've got $10 million and you're going to turn it into $11 million basically instantly by commencing on this project. Okay. So that's, and of course, right, what if this terminal value didn't exist, right? What if we couldn't actually sell the property for, the concluding property for anything? Well, now we're in negative NPV territory. This is a do not do it scenario, right? It's not gold, straw into gold if you spend 10 and get 9 or 9.5, right? That would be a gold into straw situation. And that would be bad, right? So we don't do those generally. Now, later we'll talk about how this picture can be complicated, and sometimes it makes sense to do, especially when it's this close. You can say, all right, well, we'll do the negative NPV, spend a little bit of money, because sometimes we'll learn about the market enough to make it worth it. Or maybe by entering, it like blocks a competitor, right? That's kind of a thing, right? Is we block anyway, so there's lots of reasons why this might be more strategically complex than just, oh, yeah, I lose $500,000, we're not doing it. But that's often basically as hard as you have to think about it. Okay? So that's domestic capital budgeting in a nutshell. There's lots of other domestic capital budgeting methods that aren't as good. And the fact that I'm just hard typing cash flows here is doing a lot of work. So if you were an analyst that was in charge of trying to do these calculations, there would be a whole bunch of work into generating these cash flows. We'll get into that, at least some of that, in a little bit. But this is, in principle, what's going on, right? That we have these payments, that we have a business that's generating cash, and that it shows up over time, and we adjust the interest to get to some total number of interest-adjusted dollars and compare it to the total investment and hope that the production of interest-adjusted dollars is greater than the investment. And if it's true, then that means the project is investable. And so a capital budgeting then is to say, all right, well, if I've got a project with a $1 million NPV and a project with $500,000 NPV, right? If I'm a really, the best CEOs say, okay, well, then they're both worth doing and we'll figure it out. But the reality is sometimes companies are capital constrained and they don't have borrowing capacity, and they may have to turn down positive NPV projects because they can't get financing. And so in that case, given the two choices, you would pick the higher NPV. But really, companies, unless there's some outside structural reason preventing you, if it's positive NPV and it's positive enough to be pretty confident that it's going to pan out exactly as you predict or close enough to it, then it should, just do all of them, right? These generally, it's not too often that things are mutually exclusive. So that's domestic capital budgeting in short, right? So we have this formula that we're kind of working off of. So you'll see we're going to go through a series of formulas that kind of end up being increasingly complex as we add terms to it, as we add the international features of things. But at the core, it's really kind of the same idea that we have some cash, we interest adjust it. For example, later on we'll talk about restricted funds. So it's like, oh, well, sometimes you have a company that's operating in a foreign country and they don't let you send money back. So you've got this money that's stuck in this foreign country and you can't get it out. So doing a project in the country is one way to get it out, kind of, right? Because you can say, all right, well, I have this money stuck there, but if I invest this money in a new business, now I have a new business that's generating even more money. So I have value that's accruing, and there might be a way to get that value out that doesn't involve going through capital control. So a good example is transfer pricing. So let's imagine that you've got, a subsidiary that operates in a foreign country. They don't let you send funds home. There's a bunch of profits accumulating. And you say, oh, okay, well, we will create a new business that manufactures sub component of our final thing. And that subsidiary will generate that subcomponent at bargain basement prices, but only for the parent company. And it's like, okay, so that subsidiary isn't profitable at all, but it's sending super, super cheap parts and it's super juicing up the profit of the parent back domestically, right? So that would be a way to get those restricted funds unrestricted in a sense, because you say, okay, well, I'm taking restricted funds that can't leave the country. I'm investing in the country to generate this new process. And this new process is now effectively creating a bunch of profit at home, but it's not creating profit internationally and then being subject to capital control. So that's just an example. So there I mentioned there are other methods. Internal rate of return, is basically an interest or way to look at it in terms of interest rates instead of cash. Payback is how long does it take to get your money back. That has lots of issues. Profitability index is the NPV divided by the initial capital. And you like that to be, some obviously positive, but you might set a standard of 0.05 or 0.1 or something. Anyway, those we'll just stick with NPV, but there are others. Okay, so now we're going to, all right, so this slide is entitled Expanding the NPV Equation. What does that mean? So there's just having cash flows is doing a lot of work, right? The fact is we don't actually have cash flows just there. That's usually something you have to carefully track with a bunch of accounting information. So this actually blows up the cash flow into where it actually comes from. So what we're saying in generally from an accounting standpoint is that the cash flow from operating a business in a particular period is, so here's a whole bunch of letters and I'm going to define them and we'll talk about why they're relevant. Okay, so we start with this in this parenthesis. This is the definition of net income according to accounting. So we have revenue, right? All the revenues, which that's, companies definitely track that, right? You have to for sales tax purposes in most places. So you have this. And then minus operating costs. Okay, so there's a ton of things in there, but of course we're going to be tracking costs because, we need to pay them, right? So we usually have a good handle on what those are because we have, a bookkeeping or accounting system. And then depreciation. So that depreciation is a breakage allowance, essentially. So you have physical things that you're using for your business. Think about Ubering, right? Like if you Uber around, you're making money Ubering, but you're putting wear and tear on your car. So there should be some kind of accounting for how much wear and tear you're putting on your car. And so that's where that comes from. Depreciation in that year, right? So revenue in that year, operating costs in that year, depreciation in that year, interest expense in that year, right? So that generates all of net income. And so Y1 minus this tau. Tau, this is the tax rate. Okay, so Y times this. Well, you get all that. The 1 means you get all of this net income, but then you have to subtract tau times net income for taxes, right? If you have a 30% tax rate, you're going to pay 30% of your net income as tax. So you have this huge big term times 1 minus this huge big term times tau. So you just group it. And you'll see this a lot. When you do finance, you 1 minus the tax rate is an adjustment. It's a pre-tax to post-tax adjustment factor. And, if it's a 35% corporate tax rate, that means your adjustment factor is 65%. You get 65% of whatever you would have gotten in a no tax world. So this is kind of the baseline assumption on, right? And this is net income, right? So I guess I misspoke because this is pre-tax income, and then once you take the tax out, it's net income. So this is accounting net income. And accounting net income is kind of annoying. Why? Because you do all this work to get the net income, and then you have to add back depreciation, and you have to add back, add back the interest effect, right? Because interest isn't actually, because the interest itself isn't an operating cash flow. It's a finance expense, which we're handling using the interest rate. So, so to actually get the cash flow, you have to take accounting net income and then put things back that went away. So we're going to do some manipulation here. So we'll start with, okay, let's get rid of this interest because it's just annoying that it's in there, right? So we're going to get the interest out. So this interest will just go away then, right? If I have a minus I times 1 minus tau and a plus I times 1 minus tau, those are just going to go away. So that's what's happening here, right? We don't even need to worry about interest. It's just gone, right? So now we have revenue minus operating cost minus depreciation. So that's net operating income is what we'll call that. So we have net operating income times that 1 minus tau, and then we have depreciation just hanging out. Okay, but right, if I pull the depreciation, I have minus D plus D, so that'll go away too. So really, all that matters here is that depreciate. You just so tau D, right? Tax rate times depreciation just shows up as cash, and the reason is you get a refund for that, basically, right? So if I have $1 million of depreciation and a 35% tax rate, I get $350,000 just back from the government to compensate me for the income I lost from depreciation. But of course, depreciation is like that's a we track that privately. It's not an actual payment we have to make until we replace the asset. So it just shows up as cash. So we can pull that out even, right? So you just have tau D times, right? So revenue minus operating costs, operating cash flow times 1 minus the tax rate plus tau D. Okay, so that's going to be the shortest, most compressed form we can get for figuring out those cash flows every period. And that's our nominal after-tax increment cash flow for year T. Nominal meaning not, inflation or currency adjusted. So we just, just within, if we're thinking just strictly domestically, this is how that would work. And so you could say, all right, well, now we could do a different NPV formula where we just sum up the tax adjusted operating cash flows plus tau D every year and get there. So that is the adjusted present value model, or at least, what our text terms the adjusted present value model. So you add up all of the tax adjusted operating cash flows, add up all the tau Ds, put in the terminal value. Now TV here is a tax adjusted terminal value, but those taxes are calculated a little differently. So there's kind of some subtlety here that's hidden. But for example, if you paid, in the old example, if we pay $10 million for equipment and sell it for 2, it's not actually obvious whether that's a gain or a loss. It would depend on how much depreciation had accumulated against those assets. So if it's a $10 million asset with $6 million of depreciation, we sold a $4 million thing for $2 million, we're actually going to recognize a $2 million loss there and get a tax credit of 2 million times tau. Whereas if it had depreciated 9 million, we would have a $1 million gain and have to pay tau times 1 million in tax. So this is really just, an after-tax cash terminal value. So there's a little bit of subtlety in how this is calculated, but so we have just add up all the tax-adjusted cash flows, add up all the tau Ds, throw that terminal value in, get your new NPV. Okay. So again, this is all domestic. We haven't done the international part, but it helps to break it down into this because then because we'll start adding terms for international factors, but at least we get it down into a really compressed form that's pretty easy to use. Because again, this is just revenue minus operating costs here, which we usually, can have access to. So there is, so we're talking about a paper here. This is a big deal paper. This work led to Nobel Prize, and really the kind of what happened here is thinking about the firm under different debt regimes and what's the end result for the company in terms of how much, what's the value of the firm at different debt levels. And in this case, right, we know that when you add debt, debt payments are tax deductible. So every dollar of debt saves you tau dollars, right? Tau times dollars in taxes, right? You reduce income by $1, so you save 35 cents. You reduce income by $2, you save 70 cents, that kind of thing. Right? So actually the firm is more valuable the more debt it has, which is interesting, maybe a little counterintuitive. It's also not really true in practice in that when you have too much debt, the firm is at risk of bankruptcy, and bankruptcy is really disruptive. So it's, this is only valid up to a point, but if you have a firm with no debt and you add a little bit of debt, that's generally going to be helpful as long as bankruptcy risk is negligible. And so you have, right, we can say, okay, I've got this, right? So this is just starting from this general principle of this, these, right, we got operating income over time as a steady stream, plus this additional factor. And then weighted average cost of capital is so with that, what's that? So that's the cost for the firm to raise money, right? The interest costs. And it comes from two different places, right? You have like equity capital and debt capital, and you have a weighting between them, right? So here's my equity cost and here's my debt cost, tax adjusted. And so the cost of capital for a firm is equal to the unlevered cost of capital times 1 minus tau times the fraction of debt. So again, the more debt a firm uses, the lower the cost of capital in practice. Not that it gets cheaper in reality, it gets cheaper on a tax-adjusted basis because you get to, reduce income using your interest payments. Okay, so why go through all that? Well, right, you can see this, right? Basically, this is a direct consequence of interest here, right? So you have more value the more interest you have, and so that means we can put in to this whole calculation, right? We haven't done any interest adjusting here, so we're going to throw in this interest factor to capture this value, right? So the more interest a project generates, the more value you're going to get from the tax reducing effect of interest in the exact amount of tax rate times the interest, right? So it's not really complicated. It's just there's an additional term that recognizes this tax savings. So you do actually have to know the interest level to know this value because, right, the interest provides value. I mean, another way I've seen this done, this isn't how this adjusted present value model does it, but another way I've seen this done is having the cost of capital include the tax effect of the interest, so that debt is cheaper cost, and so then the overall weight is cheaper. In this case, though, we have this feature of, we're using the unlevered cost of capital and then the interest rate. And so we have, right, so then we're not needing to calculate how much, what's the tax effect on the cost of debt financing and factoring that in. We're just using whatever the unlevered cost was and putting that in. Right, so APP is value. APV, adjusted present value model, is value additive, right? In the sense that we get value from operating it, we get value from dodging taxes and depreciation, we get value from dodging taxes with interest, we get value from scrapping the project at the end, and we lose value because we have to kick money up in front. That's sort of right. That's that additivity part where we just have these different components that each appear every year, and we have to add all of them every year. I mean, I guess this doesn't appear every year, but right, you have at least, in this case, 3 that show up every year that you're going to add every time. And all of those different sources are considered individually, and so that makes everything very explicit, which is good, right? So that's great if you're trying to do a domestic firm, analyzing a domestic project. But what happens when we go international? What happens when we take international commerce into effect? And it's gonna create a whole bunch of stuff. I mean, we'll see next time, but for sure, one thing that's obvious, right, is if I have a foreign subsidiary, my income from that subsidiary is often denominated in my foreign currency, and that means that expected future changes in the spot exchange rate are going to affect the value of a subsidiary to me in the future, right? So if I have a subsidiary that's operating in a country whose currency is rapidly depreciating relative to my own, and I can't push those value changes onto the consumers in that locality, that means from my perspective as a parent, this subsidiary is rapidly decreasing in value, even if it's happily chugging along, making exactly as much profit as it's always made. So that's where we're going in the next section.